Hey, good morning, everyone. Marty Missouri here. Friday, June 3rd, 2022, 11:49 a.m. Pacific time, to be exact, with your economic update. So we'll do the usual. We'll look at our graph. I'll talk about our score this week, look at a handful of the inputs, and I will update you on the U.S. stock market using the S&P 500 chart as our proxy. So here's our index, up actually 5+ points this week to 15.22, moving further away from that line that divides contractionary conditions with expansionary conditions by our assessment. U.S. auto sales came out this week, and that is certainly a negative, down to 12.68 million estimated this last month, which was a million below expectations. Mortgage purchase applications, a slight tick lower from the previous week, but again, just not the trend we're looking for. Average 30-year mortgage rate, 5.33%. Initial jobless claims. So we've had 2 weeks in a row of declining jobless claims, back down to 200,000 this last week. And as I continue to point out, these are historic lows. When I go back here, I talk about like 1969. This is not adjusted, and I'm sure we have at least 100 million more people living in the U.S. than we did back in 1969. So again, we do want to pay attention to the direction and the rate of change, and this move here is not a good-looking trend. As you can see, it doesn't take long historically with that trend to lead us right into recession, which are these red shaded areas. But again, we're looking at remarkably low weekly jobless claims right here, and should have us feeling relatively sanguine about the prospects for the economy, amid a lot of uncertainty. And then the all-important U.S. jobs number that came out this morning, 390, which was better than anticipated. Unemployment rate, 3.6%. Average hourly earnings, year over year, 5.2%. Month over month, 0.3. And by the way, the market is taking this news hard this morning. All in, there was nothing in this report that would remotely suggest that the Fed should back off of its monetary tightening plans, for the next few months. So on net, if the market was looking for some bad news in the jobs numbers to be good news for stocks, because it would potentially ease some of the pressure to hike rates and shrink their balance sheet, certainly didn't get that today. So the market, after yesterday's huge rally, is giving the lion's share of that back as I speak, at least. The quits rate is still elevated. Quits rate is just the rate at which people are voluntarily leaving their jobs. That typically happens when the economy is in good shape, right? It's layoffs that you want to look at when the economy is in bad shape. So that's still a historically high number. It says good things about job prospects going forward. 11.4 million job openings in the U.S. What do we have? 6 million unemployed people. So again, it's hard to start calling recession when we have these kind of employment numbers. Labor force participation rate ticked up just a bit to 62.3. So all in all, a very positive employment picture. Having said that, anecdotally, and I mentioned this in the morning written blog, when you look at interviews with companies, particularly in the tech sector, and Elon Musk, I believe it was this morning, wrote a memo to his employees that he's going to cut the labor force by 10%. We are seeing signs that the labor market may indeed have peaked, notwithstanding these huge amount of job openings, etc. The all-important Institute for Supply Managers, Purchasing Managers Indexes, they came out this week. The manufacturing survey showed actually an improvement back up to 56.10. The services sector survey, however, declined. Now, anything above 50 says that we remain in expansion territory, so we are comfortably above anything that would denote recession risk right here. And when you read through into the report, you do see a lessening of the overall breadth. Most of the industries are still growing, but one or two less than the previous month. There remain concerns about supply chain bottlenecks, not quite to the extent across all industries like we've been seeing. So there does seem to be some easing there. We still have input costs rising as a result, but not, again, not across to all industries. So you see some relatively good news on the inflation front. Still have labor constraints, finding people who qualify for the jobs that are available or who are willing to work in those jobs that are available, and so on. So again, square it all up. Certainly some deterioration, as you can see in these trends, something to be concerned about. Some people are building models based on the credit markets and everything else they're seeing and already calling for below 50 in the months to come. That's not what we do. That's not what we're seeing, quite frankly, right here. But I respect those analyses, and it just keeps us on heightened alert with regard to recession risk, because that does have implications for how we invest and where we invest and so on. Thought we'd look at the price of copper. Had a huge ramp up yesterday. I think it up like 5 or 6%. I know it was at one point during the day. So China is threatening to reopen in a big way, proposing and implementing some serious stimulus, both on the fiscal and the monetary side. That's something we've been calling for the last several weeks. We think that's bullish for commodities. There's also some mining or labor issues in Peru, which is a big producer of copper to the global marketplace, so that probably played into it as well. This sure looks like a bear flag, which would suggest we've got lower lows yet to come. While that's very possible in the near term, longer term, I think the trajectory remains much higher for copper in the months and years to come. Sector to S&P 500 ratios, what a busy looking chart. I apologize for that, but if we just focus over here, above 100, and this is for the last month, suggests that this particular sector is outperforming the S&P 500. Below 100 means it's underperforming. This is tech, slight outperformance. This is financials, slight outperformance. Consumer discretionary, noticeable underperformance. Materials, noticeable outperformance. Energy, huge outperformance. Industrials, outperformance. So of the half dozen cyclical and growthy sectors, just one actually is underperforming the S&P 500 over the last month. Among defensives, staples have actually underperformed noticeably. Utilities outperformed noticeably, and then healthcare slightly outperforming. This takes us from a neutral to a positive in our score because of what it implies about the strength of the economy. When the economically sensitive sectors are actually outperforming the S&P overall, then that says good things about prospects, or at least market implied prospects for the economy going forward. So folks, there's our data points for the week. Nice increase relative to where we've been. Nevertheless, though, we are hedging our clients' portfolios as if we have recession risk, because we think there is notable downside risk left in this market setup that we're dealing with currently. And if the economy continues to slow against inflationary pressures, that's the worst of both worlds. So we're going to have to pay very close attention to that. So let me go ahead and jump to our stock market update. We'll talk about those levels that we think make sense in the months to come. Okay, so we'll start with that 60-minute, 60-day chart. And we looked at the bullish downward wedge and then your bullish divergences here. Played out like it's supposed to. Big, momentum fueled breakout right in there. Came out of it. I mentioned that this looked toppy to me, and we were rolling over here. This is that last assessment, and sure enough, we did roll over. Found some support right on the nose, virtually where it makes sense if you were a short-term trader. Came out of it, failed to break out above that level, gapped lower this morning, and here we are holding above that support level. Going to be very interesting to see how we close the session today. But you take that's a divergent high right there, because you have a definite lower low here on the MACD and the RSI. So all that bullishness that was showing up here on the hourly chart is definitely waning before we get to our ultimate upside target here, which was 4,300. Still very well could happen. It would not surprise me in the least. It wouldn't surprise me to catch support right in here. S&P's down 1.5% on the day. Now, the daily chart to me remains much more constructive. So you have your downward wedge, right? Finally finished those bear flags that worked just almost to a T till this last one where we stopped the bleeding right here, at least short term. But we had these bullish divergences. We called those right here when we were inside this pattern right here, and sure enough, we broke out of that. You could argue that this looks very much like a bull flag pattern if we could break out above that. Let's say Monday, then we'd have a new upside target that would go about right there, which would be somewhat above our 4,300 target. And I'll show you that here on the weekly chart. So we have this, which still looks very much like a bear flag. And if we do break out of that, you do have this area where we bottomed before. If we get there, or when we get there, I think it's a win. I suspect not a small cohort believes that this is the ultimate bottom, but it just needs to be retested. And if they rush in and buy, then who knows? We could see us get back up here to our upside target, which is 4,300 and the 50% retracement level. Now, when we look back historically and we look at bear markets, right, as they develop, you tend to get kind of these waterfall sell-offs, then you get these retracements. In this case, this kind of flagging action. And then ultimately, before it's all over, you tend to retrace, 50% to 2/3. I'm saying 50% this go around because of where that falls, but 2/3 would just be above that at, say, 44.35 right here, which also coincides, if you can see this green line forming right here, with the 50-week moving average now too. So you break through here, and if this stays within that vicinity, you've got double resistance before you finally give up the ghost. We'll see. We could kind of recoil and spring back up here. Ultimately, if we can remain out of recession, I'm using that caveat, this right in here, that 200-week moving average based on a 30-year pattern that we've identified, would be where we would probably begin allocating what would be, if we get here quick, huge gains on our hedges and cash that we kept kind of sitting around in short-term vehicles for that moment. It's all about the conditions. It's all about the setup. The technicals help us a bunch with regard to entry and exit, putting new cash to work and so on. I'll leave it there. Thank you, folks, as always, for watching and listening. Much, much more to come in the days and weeks to come. So stay tuned. Take care. Have a good weekend. Bye-bye.